Thank you for tuning in to Starkey Multifamily Podcast. I have with me Rama Gupta. He works for Kapnick Insurance Company, and we're going to talk a little bit about insurance. So thanks for joining us, Rama. How are you?
Hey, Reed. I'm doing well. I'm super excited to be here on the show today. Thanks for hosting me.
Yeah. So start out, let's tell me a little bit about yourself and how did you get into insurance in the first place?
Well, like everybody who ends up in insurance, they didn't plan on being in insurance. They kind of fell into it. So I started with my firm 3 years ago, almost in January. And since then, and prior to that, I didn't have any insurance experience at all. And I actually have a science background and used to work in hospitals or in a hospital and do research. So this has been a lot of learning over the past 3 years. And I've found myself spending a majority of my time within our real estate practice. And as a firm, we do a large amount of multifamily portfolio placements. I think just over 150,000 units nationwide.
All right. So let's talk a little bit about the process of getting insurance. So when somebody comes to you and they're looking for an insurance quote, where do you start? What information do you need from them, and how do you approach it?
Typically, I like to have a short conversation about just the asset class or what their ultimate goal out of purchasing the insurance is for. Is it part of and get a good understanding of what their risk management strategy is and their approach to managing risk. So in terms of just the nuts and bolts of procuring a quote, you typically need you always need when it was built, building information like square footage, how many buildings, or the square footage for each building at the address, what type of construction, when building updates were done for like the roof, heating, electrical, plumbing. They want to know about safeguards, like is it hardwired for burglar alarms for alarms, and is the fire system hardwired as well? Are there sprinklers? Is it non-sprinklered? Just basic information like that. And then that's normally enough to get started. And then typically we'll also like to know a history of the losses. Is it self-managed, or is it through a third-party property manager?
You mean currently, or when the new buyers take it over?
So it can be both. It's to tell a narrative about the asset. So if it's a new acquisition, we do like to know about the loss history, because that gives us an idea of any potential hidden pitfalls there. So if there's been 4 electrical fires over the past 10 years, there's a good chance that the property has electrical issues, and that would raise red flags with the carrier. If you're using a third-party property manager, the carrier also likes to know that with a new acquisition, so that way, if the third-party property manager has a bad rep, or a good rep, that can really affect a lot of factors.
Okay, so let's talk about the process. So when you go to an insurance broker, would you classify yourself as an insurance broker? That would be the right term?
Yes, we would be.
So you're going and essentially looking at directly to insurance carriers and getting quotes from them, and kind of being the intermediator area, correct?
Correct.
So how does that process look? I mean, so when you talk to one insurance broker over another, what advantages can you offer, not you specifically, but can you look for when you're looking for an insurance broker when they're going to essentially the same places?
As a multifamily operator, this class of business is actually very specific. It's a niche. So you want to ensure that your broker actually specializes in this type of risk, and that the carriers they're working with actually specialize in this risk as well. And a lot of that is due to there's very specific coverages that comes with multifamily risk, and it's very specific which carriers actually work and play in this market.
Okay. what things should they ask for, like as far as types of coverage and, like, so obviously you can get different quotes for, maybe somebody will do replacement cost as opposed to actual value. That's just one major example, but what things could they look at and what differences would that make?
The specific coverages you definitely want to make sure you have are ordinance and law, which is, so say there's a loss within one of the buildings and it was built in, we'll say, the 1950s. The building code and requirements have changed significantly from that time. And if there was a loss and you had to rebuild, I think it's about 50% of that said building, it would have to be brought up to code. Well, bringing it up to code, say all the windows had to be replaced because they weren't, new window specifications were, had changed from the 1950s till now. So that extra cost would not be paid by the claim, and that would be paid out of the ordinance and law coverage. One thing we've been seeing trending is tenant discrimination exclusion or assault and battery exclusion. So that would be so we'll use assault and battery. If somebody got shot at the property, they could look at the owner or the property management company and try and point the finger, or like sue them that way as well. You need to make sure that your buildings are insured for the proper value as well. So each carrier is very specific and has different requirements, but typically you want to make sure that your buildings are insured for, at replacement cost, $125 a square foot. That's given the current state of the market right now.
Now, your insurance company, or not your insurance company, your lender is going to have some requirements as well. Are those typically enough, or are there requirements beyond what the lender asked for that you think you should get?
It really depends on the lender. So Fannie and Freddie, they typically just want to make sure that the liability is sufficient and the property is insured for replacement costs. So at the end of the day, they really just care that they get their money back in the event of a loss. Mm-hmm. And they don't require ordinance and law or water backup. They could require flood depending if it's in a certain flood zone. But no, those requirements are more lax than what you should have.
Okay. And then so we've got, the ordinance one you mentioned, mm-hmm. And then you've got the assault and battery one and then the discrimination. So I assume that it covers if somebody says we hired somebody against the Civil Rights Act.
So tenant discrimination, that's more for, I'm not quite sure what the law says, but basically you have to obey fair housing guidelines. So you can't not rent to somebody because they have, 5 kids and they're trying to rent a 2-bedroom apartment, and it's mostly a young professional community.
Okay.
Or, based on sex, age, race, etc. So it comes back to hiring, or not hiring, but I guess hiring practices and making sure whoever does the leasing is knowledgeable about those laws.
Yeah, absolutely. Let's kind of segue into an umbrella policy, or not an umbrella, but a master policy. So if somebody has a lot of units, when does it become worthwhile to get a master policy on their units?
So I would say at about 1,000 units, that's when it makes sense in the multifamily world to utilize a master policy. Some of the benefits of master policy is it creates efficiencies. If you have a larger suite of coverages available, you're able to leverage economies of scale. You can get higher limits. The risk is really spread across the portfolio. So think about it like this. So you can have each of these properties as a standalone policy. We'll say each policy costs $50,000. If there's a $500,000 or $1 million loss on one of these $50,000 policies, your you're kind of going to be screwed at the next renewal, because if you're only paying 50 grand in premium, but the carrier just paid out $500,000 to $1 million. So they're either going to non-renew you or jack up the rate. So if it's on a master policy, you have a loss on that. So think of the master policy as almost like a mini insurance marketplace. So all the properties on that policy are paying premium to spread the risk across the whole portfolio. So if you have 1,000 units and you have $500,000 loss on the master policy is going to have a lot more tolerance for that loss and absorb it. And you're not going to get A, non-renewed, or B, have a 50 to 100% increase on your renewal.
So yeah, I've never heard that perspective. I've always been told that it was an insurance premium saver, but you're talking about it more as spreading the risk amongst all of your assets. So
it will save premium as you're leveraging economies of scale. So you'll be able to obtain lower rates. Yes. But from a risk management perspective, think of it as, exactly, spreading the risk amongst all the assets.
So some property managers have insurance, like a master policy that their property owners can tag onto. Is that kind of the same benefits, or so would you advise taking advantage of that? So we've talked to property managers that offer that. Is that beneficial for them to?
Going back to the owner's approach to risk and risk management, absolutely. We work with a lot of third-party property managers, and some do opt to obtain insurance through their own contacts and not join the master policy. Sometimes that does make sense. I do encourage, if you're using a third-party property manager, to go out and see what you can come up with on your own, because that kind of gives you an idea of what the insurance marketplace is like currently. So you can weigh the cost benefit of whether it makes sense to join the master policy. And conversely, you could go out and procure the policy on your own. And if there was a bad loss and they did jack you around, you could add the asset to the master policy later on.
Okay. And then, a little bit out of order, but maybe in case somebody's listening and they don't know what a master policy is, can you explain exactly what that is?
Yeah, absolutely. So typically, or I guess one way you can do it is you can have each property you own have its own insurance policy. It's like a standalone. So let's say you have 30 different communities or assets. You have 30 different bills. Each property is scheduled within each policy, or a master policy creates basically one insurance policy. Every property is scheduled within the master policy, and it's there's more, I guess, insured value within that one policy. So that's how you can leverage the economies of scale. So basically, it cleans up the administrative burden and creates one policy as opposed to like 30 different ones.
Got it. Okay, so and we had talked a little bit about layered or quota share programs.
Mm-hmm.
Can you tell us what those are?
So a layered or quota share program is typically for those larger schedules. I've seen it as low as 1,500, 2,000 units, but it's normally a tougher asset class, less desirable. So with a quota share, you'll get multiple carriers to share basically split the risk. So if there's a loss, you'll have 3 carriers. So say there's $1 million loss, you'll have 3 carriers. One could be covering the half a million of it, so they'd be 50% quota share, and then you have 2 others sharing in 25%. So one would take the loss for 500,000, the other 2 would pay 250,000. With a layered program, you basically just stack carriers on top of it. So say you've got a $25 million total insured value portfolio. So you'd have one carrier that would take the first, we'll say 2.5 million. And then you'd have another carrier that would say, we'll take 2.5 to 5 million. So if a loss was, say, $50 million, you'd have the first 2 carriers that would take the 5, and then you'd have another one above that would say take from 5 to 10 or 5 to 15 million. That's how they share it. That's how they would do the layered program, whereas the quota share, each carrier takes a percentage of that loss and pays that out.
So why, you said in maybe a bad area and maybe a large asset, but is that the only reason you would do that, is if you had something that's maybe you can't find a carrier to take the risk of that asset?
Yes. So you would typically do that when you cannot find a standard carrier or market that will either write the whole portfolio. Basically, they don't want to take on that whole risk because
Yeah.
they view it as not, it's not going to be, they view it as not something that's within their appetite, or they think it's going to be unprofitable. It just, basically, it's a tougher risk that you can't get a carrier comfortable with.
So it's almost so I've read about insurance companies syndicating um, coverage. Is that similar to is that like the same thing, or is that a different?
Yep. That's basically exactly what it is.
So that,
Um,
so you're, so it wouldn't be something that the owner would take on. It would be like the insurance carrier would say, okay, I'll take this on, but I'm going to syndicate it with some other insurance carriers.
Yes. So it would typically, so the owner would take the portfolio to a broker, and the broker would go to their markets. And if they couldn't place it with a standard market, then they would go to, um, there's a couple programs out there where you can approach it, which basically is a syndication or quota share, or they can go put together a layered program to address so I've seen um, on very large portfolios, I'd say above 250 million insured value on up, you'll often see a layered program just because it's so much risk within one portfolio. So most carriers can go up to 50 to 100 million of total insured value within a portfolio with no issue. But above 100 million, that's a lot of risk for one carrier to just sit on. So they like to insure. So that's when you would do a layered program.
Do they look at location? So if I had a large portfolio in, maybe the West Coast, East Coast, all over the country, it's unlikely that they're going to have a total loss for all that. Do they take that into consideration?
Yes, they do. If there's too much concentration, so apparently Indiana is over the last couple of years, they've had a lot of hail losses. So if they see a high concentration of, um, I guess, communities or properties within a certain region that is known for a specific type of loss, they will balk at that and not want to. Um, so that would be an instance where they'll go into a quota share or like a layered program. We see that a lot in North Texas, Oklahoma. That's a large hail area as well. Um, California, with the severity of the claims from wildfires, that has been another tough area as well. But yeah, they absolutely take that in consideration. Southern Florida, the coastal states that are subject to hurricanes.
All right. So moving on to maybe a little simpler stuff that more people can relate to here. Talking about renters insurance. Is that a product that you work with?
Yeah, so there are, yeah, first and foremost, renters tenant liability should always be, it's a best practice that should always be in use. There are several providers out there, and it depends on what type of asset it is, which offer really robust tenant liability programs. Um, Again, so you have to have the conversation with yourself and your team. What's your approach to risk management? So tenant liability would cover any tenant caused damages. So we're talking if the tenant starts a fire, if they have a sink that overflows and causes water damage to the units below. If they those are the two big ones right there. Basically, if it's a tenant caused loss, it's not for the wear and tear of the carpet like that. So why is that becoming more popular, or more, I guess, a best practice that's being implemented is the insurance marketplace the market is hardening. So that means rates are going up and insurance carriers are asking for larger deductibles. It's not uncommon to see a $25,000 deductible right now. A lot of the larger portfolios are sitting at $100,000 deductible. So this is really when the tenant insurance is useful.
So So explain that to me. So this is not the like renter's insurance that the renter would pay for. You're talking about an insurance that the owner would pay for that covers damages that the tenant causes.
No, it would be you would want the tenant to pay for it. So it would be very popular one is Lemonade. They're known for their renter's insurance.
Mhm.
The challenge that owners deal with is actual compliance of the renter's insurance and making sure that they don't just buy it, move in, and then cancel it, or that they actually have it. So managing that's very tough. There are certain programs out there where the owner can purchase tenant liability insurance across their portfolio and then charge it back to the tenant to collect it as additional rent. Um, typically you want the tenant to purchase that though.
Okay. And then, so let's talk about what that covers, because I had always understood that as covering, um, so if the house burns down, or if the apartment burns down, the structure is covered by the owner's insurance, but the contents that the owner or the renter owns are not covered. And then that's why he would get his renter's insurance. But you're saying there's more to it than that.
Yeah, so there's two parts of that. So if the tenant starts a cooking fire, they're technically liable for that. So the owner could go after the tenant, but there's a good chance the tenant doesn't have $100,000 to, or
Right.
whatever it is, to pay for that. So it's really a personal liability coverage to protect against anything I cause or any damage I cause to, if I cause a claim, fire, water damage. Those are really the big ones that are tenant caused. The personal property coverage through the renter's insurance, that's purely for the tenant's personal belongings. The insurance that the owner purchases does not cover tenant belongings.
Got it. So if the tenant did not have that insurance and they did, let's say they caused a fire, they're cooking and their whole apartment unit is burnt, would the regular insurance that we would carry as an owner not cover that?
It would.
Okay.
It would, but then you're responsible for the deductible and the tenant's liable for it, but you're never going to collect on it.
Okay, so it's like the $25,000 deductible that we'd be on the hook for.
Correct.
Okay, well, that's good information to know. But you said there's two different ones, or is that covered under the same policy? Would they all get one that covers both of those, or two separate policies?
So if the tenant goes out and gets their own insurance, they can purchase. They can buy the property coverage that they believe is sufficient. Some owners make available a kind of like a pre-approved renter's insurance program for their tenants, and they still give the tenant the option to bring their own insurance. But the pre-approved one, that's primarily focusing on making sure the tenant has liability coverage. Because at the end of the day, the owner, they shouldn't actually care whether the tenant purchases liability coverage. Every tenant should have the property coverage, but the liability is what's most important there. There's also a few options out there where they call it's owners can enroll their assets or their community properties within a captive, and the tenants opt in for they pay a fee per month collected as additional rent, and for that they waive the tenant liability requirement, and if there is a claim, the captive would pay the owner. So it's almost like purchasing renter's insurance without buying the liability, or it's almost like buying the tenant liability insurance without buying it. It's a waiver almost.
Yeah, so the owner is essentially doing a master policy for it and then having everybody pay into it.
Correct.
Yeah. So I did see somebody post on that, and they had suggested that you could actually profit from that. The general feedback of the community was that was kind of a little shady and maybe not worth the effort. But what are your thoughts on that?
It depends on your size. It's absolutely something that the owners can turn into an additional revenue stream. We run a renter's insurance program for a very large operator. north of 50,000 beds, and the typical returns are about 20% paid back. Well, it's not paid back, but the operator can make up to about 20% on that, allocated back to the properties. It's typically advertised as a marketing fee or a typically a marketing fee. So like the captive I was referring to earlier, it's paid back to the owner or the operator as a marketing fee.
And then circling back, you had mentioned that, some of the risk is that the tenant could get the insurance and then back out of it.
Mm-hmm.
Can you, as the property owner, request that they list you as a secondary insured so you get notified if they drop the policy?
Absolutely. So you would always want to make sure that you are listed as an additional interest not to be confused with an additional insured. An additional interest is for notification purposes. So yes, you would want to make sure that you are listed there. There's several providers or vendors out there that will do this administrative part for you, so that way you're not keeping track of the compliance. Your property managers or leasing agents aren't following up with non-compliant residents. Then they don't have to be experts in insurance either.
And who did you say does that type of stuff?
So let me think. So there's a couple out there. Effective Coverage, the captive, I know does this as well for the owners. I believe ePremium will help with the administrative burden. A lot say they'll do it, but you really have to vet to see if they will.
Yeah, I imagine even on a smaller 100 unit or so, that could be overwhelming in the keeping track of every tenant and when they move out, move in, and what they've got. So that could be, I can see that getting to be a lot of work. But
yeah, it's really low spend of the operator's time and their staff, if they have any, versus it's definitely something to farm out to someone who does. That's what the vendor does that's the service they provide.
Yeah, but I'm sure whatever they charge, one claim would pay for itself. If you're coming out of pocket with that 25,000 or that insurance company's covering it, that's a massive loss. Especially on a smaller property.
Yeah. I don't have any association with ePremium other than we use them or we partner with them from time to time. But they also, if your assets are enrolled in their renter's insurance program, they also have a deposit waiver. It's basically a deposit insurance. So as everything's moving to a subscription based kind of economy, in lieu of coming up with 1.5 months rent, you can pay $250 or $300 as a non-refundable waiver that provides the landlord insurance up to 1.5 of whatever the security deposit would be, and the tenant pays the one-time fee, so they don't have to come up with all that money, and they it's not refundable at the end of it.
Yeah, I see a lot of people going to that, especially in markets when we're looking at. I mean, the security deposit at all the comparables were like $300.
Right.
And I'm looking at that thinking, well, that doesn't cover anything. So usually the 1.5 times the market rent doesn't cover much, but so that's interesting. You had corrected me earlier on secondary insured and secondary interest. Can you tell me what the difference is?
Yeah. So an additional insured, they actually have an insurable interest in whatever it is that's being insured. So with the tenant liability, you don't actually have an interest. The owner doesn't actually have an interest in, I guess, the tenant's liability coverage, but they do require it as part of the lease. So that's why the additional interest is used for notification purposes. So we'll use the bank. So you've got a mortgage, for instance. They're called a mortgagee, but they would be an additional insured because they have an insurable interest in your asset.
Got it.
Does that make sense?
It does. Okay, so That was all the questions I had on insurance. So what are we missing? Oh, I did have one more that I thought of while we were talking. Aluminum wires. Let's talk about those. So,
Yes, that is an underwriting question on every application. And so I think aluminum wires were used from, I think, the mid 1950s through about 1965.
mhm,
Um, you can tell they're aluminum wires by they kind of have a silver coating that coats the wires. Um, and it's my understanding that this coating will deteriorate over time. And don't quote me on this. This is just what I'm remembering right now. It'll deteriorate over time, and it's found to be a source of electrical fires, which results in an increased frequency of claims within properties that have that.
yeah. So if you say that you don't have aluminum wiring, and whether it be ignorance or on purpose, and your apartment burns down, you get nothing if it's found to have aluminum. Is that correct?
Well, no, the insurer would still pay out, but it would be a tough situation. Um, if it was found that there was an actual material misrepresentation, so like somebody did know and they just said no, I mean, so that's typically why they'll loss control or do an inspection on the property to actually see. I don't think there's any insurer out there that won't do a loss control visit to double check to make sure there's not aluminum wiring.
Right.
So they have that safeguard in place, but there's very few instances where an insurer would not pay out.
Okay. So I want to follow up on that, but we'll keep going on the aluminum wires for a little bit. So when you fix them, so let's say I'm looking at a building that has aluminum wiring, and I'm looking to purchase it. Do I pay a higher premium with you, or is it not insurable? How does that work? What is the?
You can insure it, but it's going to end up in excess and surplus lines. So excess and surplus lines are where really crappy risks end up. Typically, the terms are terrible. I can't say terrible. They're not great. It's really there's a lot of requirements for it as well. At the end of the day, it's going to be a huge pain.
Mhm. So
Um, God.
what is the fix for that? Are you replacing the whole wires? Or are you replacing just the ends? What is the?
That I don't have a good answer for that. I know that typically they'll have to contract with you'll hire a contractor to come in and fix it. I'm not I don't have a good one. I haven't gone into the depth of what remediation of that looks like.
We'll have to dig into it. So I did just ask somebody recently, and they said that there was a pigtail replacement for them. But I was hoping you had expert knowledge on that. But
I
well,
think that sounds right, but I would double check, or if you want, that's something I can get back to you on. I say I've got a couple points we can address as well. So part of being basically this will cover like risk management best practices, most common claims, and tying those two together, and then the importance of good risk management practices because of the hardening market right now. So within that, the most common claims right now, the drivers of loss are kitchen fires and electrical fires on the property side. So that can be kitchen fires. Typically, it's a grease fire. With the electrical, it could be too many. Could be like 3 power strips plugged into the same power strip, overloading that circuit. For general liability, it's slip and falls. So for instance, this is an example we use. If you have maintenance staff, and this is a best practice, so if you have maintenance staff going into a unit we'll say fix a dishwasher, you want to make sure that they've got a checklist. So while they're in that unit, they're looking at other things. Does the apartment look very cluttered? Is there a buildup of grease on the stove? Because it's not typically grease fires don't just happen, because it's just a one-off thing. It's
right.
because of the buildup of grease. So that tenant might cook with a lot of grease. And that's just something to make note of. So that way the maintenance person can let the management team know, and then the management team can address that with the tenant. So that'll fall under like the proactive risk management. You can't prevent all the claims from happening, but you can take steps to mitigate those. With slip and falls, it's always important to make sure that up here we're in the Midwest, we get snow and ice. Making sure your parking lots and stairwells are well lit. Those are all helpful and just best practices. So state of the market. So for the past 10 years, rates have been soft or decreasing. And then as of, I'd say the last 18 months or so, there's been an increase in catastrophic losses, probably 2 years, hailstorms, wildfires. And what this has caused to happen is the reinsurance markets are getting hit. So that's basically the insurance that the insurance company buys. So they get reinsurance. So with that, when the reinsurance carriers are experiencing losses, they increase their rates for the insurance company, thus leading to increased rates, property and liability rates. There's also been a reduced capacity in the umbrella market because of just how litigious our culture is, and there's a lot more lawsuits that are hitting the umbrella.
Yeah, that's interesting. So when you say the umbrella, are people getting umbrellas in addition to their regular insurance on the apartment complexes?
Typically, yes. Well, again, it comes back to their approach to risk management. An umbrella is not too expensive when you're looking at just an individual, I guess, property or community. It's typically $400 to $500 per $1 million or per $1 million of excess coverage from what I've seen lately. And for a single community, we would recommend $3 million in excess with a total for about $5 million in liability coverage for any one incident.
Okay.
Back to the risk management best practices, it's using all those examples I just shared. So when you communicate those to your broker, the broker can take those to the carrier, and it helps tell a better narrative and make you a more attractive risk. If they just see what's on paper, they just see the property information and the loss information. They don't know about the management practices. They don't know the intent or the plan for upgrading and improving properties. So it really helps to be able to communicate and share those best practices. Carriers lately have really been wanting or requiring or even offering credit for installing fire stops, which that's basically it's a can of baking soda that goes in under the hood of over a stove. So if there's a grease fire, it goes off and puts the fire out. It would thus preventing the kitchen fire from even happening.
Yeah, and so if you were to send in your CapEx of some safety stuff that you had planned to add to a property, that would be advantageous for you to do so?
For fire stops, absolutely. That's the market's getting tougher, so some carriers are either requiring them, or so they won't even consider the risk if they're not installed, or they're offering credit on the property coverage for having those installed. And as the market gets harder, rates are going up. I mean, it's a small investment for a good return.
Yeah, I mean, what about if things in your CapEx? So I happen to be looking at an actual plan that we're using right now. So we've got the fire suppression, thanks to your advice. And we've got like some exterior lighting upgrades. We've got non-skid stair treads, just some various things like that. Are those worth sharing with the insurance broker?
Absolutely. Anything like that really helps them tell a better narrative, but you have to have an understanding. So again, that's why it's important to go to a broker that specializes in multifamily coverages and know that they're working with carriers that identify that, hey, these are good safe, or these are good practices that the owners are putting into practice. The big drivers of improvements, they like to see that there's been a roof within 15 years, replaced. If they like to see that the electrical's been upgraded. If it's built in the 60s, 70s.
So I do have one last question. The lost rent insurance.
Mm-hmm.
Can you tell us about a little bit? I think it's probably self-explanatory what it covers, but if you can go into it a little bit and what your opinions are, if it's worth it, or what advantages, disadvantages to it are.
Absolutely. So consider loss of rent insurance. It's basically business income insurance. So if there is a loss, you've got the property. You've got the property coverage to replace the building, but nothing is replacing the rental income that you were having during that time. Then you're looking at a minimum of 12 months to get the building back up, probably 18 months to get it leased back up. So you would want to have the business income included within that for about 18 months with the option of 3 months extension for delays.
And how do they do the math on that? So, I mean, obviously, those things are cyclical and they go up and down. And, if depending on where you are in the purchase and value add cycle, those numbers could change quite a lot. So where does that number come from?
So it's typically a conversation that you would have with your broker, and when the broker markets this to a carrier, they'll provide a statement of values. And on the statement of values, it has each location and each building at the location, information about each building at the location, and you can have the rental income per building.
So you're picking this when you sign up for the insurance, not when it happens. So
correct, and it's evaluated on a 12-month basis, so for a year.
Okay, so you would be able to, and you could estimate that high then, and then just have it cover wherever you're at. So if you're doing value add and you're raising rents, you're not going to know where it's going to be. I mean, you might be pretty close, but I mean, you could go maybe high, or would it be wise to go maybe on the low side? Or
so I would try and what I would do is I'd look at last year's pro forma, because they typically there's a little asterisk there that says actual loss sustained. So they're going to look at the ledger for that building and say, all right, this is what the rental income has been for, say, the last 6 months, and that's what they would base it off of.
So it'd be better to maybe err on the side of less than actual, because they're not going to pay. They're going to argue with you anyway on what you were actually losing, I assume.
Yeah, I think you'll have the ledger, so you'll be able to see what the last couple of months looked like, and that's pretty sound, cut and dry.
Yeah. Now sometimes you may be able to offset that. So if you can move some of those tenants, let's say you have 3 units go down, but you have vacants around that you can move those tenants, would you not take advantage of that loss then?
Yes, you would want to take advantage of that loss.
You still would?
Yes.
Awesome. So when you quote that out, do you add that in normally, or is that something they would ask for additionally?
So it's typically, it should always be included. So what the insurer does, it's all part of the property rate. So they take the total insured value of the building, and then they add the business income or loss of rents to that number, and then they'll basically tally up the TIV, and they call it the total insured value, including the business income for that whole portfolio or community or property, and that's how they come up with the property rate.
So let's say we have that insurance and our building burns down today, and I've got 8 tenants with no home. I have to put them up, let's say, in a hotel for maybe even a month time. Is it going to cover that as well? Or what insurance would pay that?
Typically the tenant's renter's insurance.
Okay. So they wouldn't be able to come after the owner for that?
No.
Okay.
Well, defer back to the lease.
Yeah. Okay. What if so let's say so the same thing would be for like a water backup or any reason their insurance would cover them going into like a hotel.
Yes.
Okay.
Yep. So that's why it's important for the tenants to have insurance, and a lot of times they don't think they need it. So with like water backup, that's if water comes up out of drains and sewers and causes damage. So you can look at the area it's in, and you can see the history of whether that's happened in the past. And it, if you don't have that endorsement within your property coverage, there's no coverage for it from the owner's perspective. So that's why it's a specialized coverage, and you need that.
Yeah. Well, that's very wise advice. So what else? So you got tons of information. Is there anything that we have not covered today?
Really, okay. So state of the market a little bit more. There's a lot of acquisitions happening due to 1031s and low interest rates. So that's also so that you're seeing a lot of assets changing hands. Also, that means there's not a lot of deals out there. Yeah, I didn't touch on blanket coverage versus, I guess individually, I guess coverage limits by building. So what we like to do is have blanket coverage per location. So we add up the total value of the buildings, the total insured value of the buildings, and the business income, and just blanket it for that single location. As opposed to if it's by building, so we'll say it's insured for 800,000. That's the most that they would pay out for that building.
So the insurance carrier will only pay a max out per building.
Right.
But if there's more than one building damaged, they'll still pay both.
Yes.
So that goes on the other side too. So we've talked about, not you and I, but I've looked at where the deductible can be per building or per incident.
Yep. So so again, that's why blanket is more favorable, because the deductible would be per building if it's not on a blanket basis.
Yeah, because that could be devastating if you've got in the bank 25 grand for an insurance claim, and it's 8 buildings and they just all had a total loss, or a hailstorm or something crazy.
Mm-hmm.
Now you're out $200,000,
Right.
which could devastate most budgets. So that's definitely something to look into. Do you usually go the one way? So you go with the blanket, like you said?
We always recommend blanket. Yeah, we absolutely always recommend them. Sometimes it can cost a little bit more, but it's it's what we lead with. It's at the end of the day, it's up to the owners.
So that's another example, like we were talking in the very beginning of, these insurance brokers may be going to the same carriers, so you may think it doesn't matter, but knowing those type of things and seeing, okay, so you got or broker A and broker B. Broker A might be cheaper, but maybe he went with something that's going to cost you, that could bankrupt you if you have a total loss on several buildings, or the other way you would have your standard deductible. So I think those are real important things to think about. If you're saving, a few $100 a month, it's a better deal, but when you dig into it, it may not be.
Right. And again, it's important to understand your approach to the risk management. If you don't think there's going to be a loss and that's how you approach everything, then you're going to buy the cheapest one. An example we use is I believe probably about 15 years ago, Ford itself, they decided to go move their deductible up to $100 million. Not 1 week later, and this was, as a leadership team, they decided they were going to take on more risk, like a $500 million loss so I think a plant blew up or something. I don't know the specifics, but they all kind of looked at the decision-making team and they said, we as a team and a company agreed this is our approach to risk management. We are going to retain more risk.
Yeah, that's a brutal hit. So I've worked for some companies that did, as they called, self-insured, but their deductible was $1 million, so it wasn't nearly what you're talking about. But so I guess it's really not self-insured, but they qualified it as self-insured.
Mm-hmm. So we've also with the hardening market, we've seen instances where it's a larger client where they'll put up the first 2.5 million in, basically they self-insure for the first 2.5 million in losses, and then they have an insurer that it's almost like you're self-insuring and then you have reinsurance above any losses above 2.5 million. So in that instance,
layering it.
Yeah.
I get it. Yeah, that's definitely a different approach. I mean, I guess you got to be much bigger than I am currently at. So you'd have to be pretty big to get to that point. But
Well, it's important to understand where you're at, and as you grow, your tolerance for risk will likely increase. But like as you're starting out, I think it's important. You can see the payoff amount was like 10 years, moving it from a 1,000 to a 5,000. So it makes sense to keep the $1,000 deductible.
okay, yeah.